Okay, here's a number that really makes you stop and think. Something like, what, 80% of retail investors trading CFDs?
Contracts for difference, yeah. Highly leveraged stuff, often.
Exactly. And 80% end up losing money. That's,
Mhm.
wow.
That's a stark figure, definitely.
And it's a perfect lead-in to
Mm.
what we're digging into today, copy trading. I mean, you've probably seen it advertised, right?
Oh, yeah, it's everywhere. The idea you can just automatically copy what supposedly experienced traders are doing.
Right, on these social trading platforms.
Mhm.
Sounds like such a neat shortcut, you know? Especially if you're new to trading.
Yeah, I mean, it definitely looks appealing right off the bat. You think, okay, I can skip the hard part, just follow someone who knows what they're doing.
Okay, so let's really unpack this. We've gathered quite a bit of material. We've got an academic study from the Essex Research Repository looking experimentally at this stuff.
Mm-hmm. Actual controlled research.
Plus articles from places like TIO Markets, Pepperstone, MAU. They explain the basics and review things.
Standard financial site stuff.
And then, crucially, we looked at discussions on Reddit. You know, real people talking about their actual experiences.
Yeah, the unvarnished truth sometimes.
And even a risk disclosure from a platform, Joe, Teke Ltd. So our mission here is to get past the glossy ads.
Right.
I want to understand how it works, sure, but also what the real benefits might be, and maybe more importantly, the risks, the things you really need to watch out for.
Exactly. Think of this as your crash course, getting you up to speed on what copy trading actually involves, drawing from, well, everything from academic findings to those forum horror stories.
We're not just taking their word for it, we're looking at the data, the experiences.
Let's do it.
So, all right, let's get down to brass tacks. How does this copy trading thing actually function, mechanically speaking?
Well, at its core, it's pretty simple. You go onto one of these social trading platforms, you browse through traders,
Yeah.
you find someone you like the look of based on their stats or whatever, and you choose to copy them.
And copy means
Yeah.
linking your account somehow.
Exactly. You link your investment account. Then whenever that trader you're copying makes a move, opens a trade, closes a trade, the platform automatically does the same thing in your account.
Got it. So it's like putting their decisions on autopilot in your portfolio.
Pretty much, yeah. And, as sites like TIO Markets and Pepperstone explain, it's not always all or nothing. Often you get options, like maybe you only copy certain types of trades, or maybe you copy everything.
And you can set limits, like risk controls.
Usually, yes. Things like setting a maximum investment amount per trade or putting in stop losses to try and cap potential downsides.
Right, that seems important. And the platforms themselves, the social trading sites, they're the middlemen here.
Absolutely. They provide all the tech, the plumbing that makes this connection, and the automatic trade replication possible.
Okay.
Plus, they usually give you tools to evaluate the traders, performance history, risk scores, maybe forums where people chat about them.
Right, performance stats, monitoring tools, that kind of thing.
Community features too.
Okay, so that's the how. Let's talk about the why. What's the big attraction? Why are people flocking to this?
Well, there are a few angles. TIO Markets mentions accessing proven strategies, getting exposure to what experienced traders are doing.
Like borrowing their brain, almost.
Kind of, yeah. For someone just starting out who feels overwhelmed by market analysis, it seems like a way in, a shortcut to potentially making profits without years of learning.
I can see the appeal there. It saves time too, right?
Definitely. MEU highlights that. If you've got a busy job, family, whatever, you might not have hours to stare at charts. Following someone else seems efficient. And potentially diversification. If you copy a few different traders using different tactics, maybe that spreads your risk a bit.
Okay. And it might take the emotion out of it if you're just following someone disciplined.
That's another potential plus. Reducing that emotional decision-making that trips up so many individual investors. So yeah, potential profits, learning by watching, saving time. It's a compelling package.
It really is. But, like we hinted at the beginning, there's always another side to the coin, isn't there?
There absolutely is. And this is where things get, well, more complex. The risks.
Let's get into that. That academic paper you mentioned, the Essex one. What did it find?
Right, copy trading. This is really interesting. Their experiments showed that when people engage in copy trading, they actually tend to take more risk, significantly more.
Wait, really? That
Yeah.
seems backwards. Wouldn't following someone else make you less risky?
You'd think so, but no. The experiment found that giving people info about what others were doing and the option to copy, it led them to choose riskier assets. And here's the kicker. People who were naturally more risk-averse were actually more likely to copy someone. And by doing so, they end up taking on more risk than they probably would have otherwise.
Wow, that's counterintuitive. Why? What's going on there?
Well, the researchers suggested a couple of things. One big one is chasing performance, right? People tend to copy the traders with the absolute best recent returns. But how do you get those amazing returns quickly? Often by taking big bets on risky stuff.
Ah, so copying the winners actually means copying the risk takers.
Pretty much. So copiers get pulled towards riskier strategies, maybe without fully realizing it. The study even saw a shift towards riskier assets among people who didn't copy, just because they saw what the high flyers were doing.
Just seeing the information changes behavior.
Yeah, and they also talked about a kind of psychological distancing. Like if you're copying, maybe it doesn't feel like you're the one making the risky bet.
Right, like it's someone else's decision, even though it's your money.
Exactly. And that feeling can make you override your own natural caution. It's a powerful effect.
Okay, so that's a major psychological pitfall. What about more practical problems? MAU mentioned some.
Yeah, several. One is delayed information. You might look at a trader's disclosed holdings, but those filings are often quarterly.
So the info could be months out of date.
Totally. What they held 3 months ago might be ancient history in today's market. Their current strategy could be completely different.
That makes sense. What else?
Different risk tolerance. A pro trader might have a huge appetite for risk, way beyond what's suitable for you personally.
Mm-hmm. Their ability to handle losses could be totally different.
Vastly different. And of course, market volatility, Pepperstone, reminds us of this. Markets can turn on a dime. Unexpected events happen.
And past performance is no guarantee.
Yeah.
The classic disclaimer.
It's classic for a reason, it's true.
Yeah.
And MAU also notes that pros might not even disclose their entire portfolio. You might only be seeing a slice of it.
So you could be copying the risky slice without seeing the safer stuff that balances it out for them.
Precisely. Which brings us nicely, or maybe not so nicely, to the stuff people are talking about on Reddit, the real-world complaints.
Uh-oh. What kind of things?
Well, some pretty worrying anecdotes. People talking about alleged scams, unexpected fees popping up when they try to withdraw money. Yeah, or just straight up difficulty getting their funds back. Imagine seeing profits on screen but not being able to access them.
That's nightmare fuel for an investor.
Absolutely. Users worried about potentially fake stats being used to lure people in, promising crazy high returns.
So too good to be true stuff.
Exactly. And a really important technical point. Margin differences. The copier might not have the same amount of leverage or margin available as the trader they're copying. Meaning a trade could get automatically closed out on your end because you hit a margin call, even if the original trader has enough capital to ride out the dip.
Ah, so the same trade can have very different outcomes because of the account specifics.
Big time. Then there are sync issues. Maybe your copy trade goes through a fraction of a second later at a slightly different price. Doesn't sound like much, but it adds up.
Right.
And, just the basic fact that even good traders lose sometimes. Reddit users shared stories of following someone who looked great, then hit a bad streak. And when you copy, you're stuck. You don't control the individual trades.
You're along for the ride, good or bad. Plus those fees you mentioned earlier.
Yeah, unexpected charges cropping up. That came up a few times. It all erodes any potential gains.
So the user experience reports sound, well, a lot messier than the marketing suggests.
That sums it up pretty well. And you have to remember the regulatory side, too. That NJKE LTD disclosure pointed out that rules change depending on where you are.
Right, jurisdiction matters.
And they had the standard disclaimers. This isn't financial advice. Get independent advice. Be aware of cyber risks like hacking.
Important reminders.
Yeah.
You're trusting these platforms with a lot.
Okay. But amidst the warnings on Reddit,
Yeah.
was there any constructive advice from people who maybe navigated it better?
Yeah, there was some. More experienced users stressed doing serious homework before copying anyone. Like, look beyond just the last month's returns.
Look long term.
Exactly. Check their long-term charts. Try to figure out how they trade, what their risk management looks like. Is it consistent?
And then, maybe controversially, some said, once you do choose someone, try not to meddle too much. Let their strategy play out, even if there are bumps.
So don't panic sell at the first dip if you've chosen someone with a longer view. That requires patience.
It does, and understanding. You need to pick someone whose risk approach actually fits your comfort level and goals.
Right. Don't copy a day trader if you're trying to invest for retirement in 20 years.
Precisely. One user suggested if you're copying a long-term investor, you probably need to copy all their positions to get the intended effect, but be prepared to wait maybe years for results.
Okay.
They also mentioned dollar cost averaging, putting in a fixed amount regularly rather than one lump sum that could potentially smooth out the risk.
That's definitely a more measured approach than just hitting copy and hoping for the best. It shows you still need a strategy yourself.
You absolutely do. Now, MAU brought up another angle entirely mirroring the legends. What was that about?
Yeah, that's interesting. So the idea is instead of copying anonymous trader X on a platform, you try to replicate the publicly disclosed holdings of famous investors.
Like Warren Buffett, George Soros, those guys.
Exactly. Buffett, Soros, Ray Dalio, Peter Lynch. You look at their 13F filings or other disclosures and try to mirror their portfolios.
So, copy trading, but with the titans of investing.
That's the concept. MAU touched on their styles value, macro, all-weather growth. The appeal is similar. Tapping into proven success, maybe getting diversification.
But I bet the same risks apply, maybe even more so. That delayed information issue must be huge, absolutely critical. Those filings are quarterly, sometimes with a lag even then. What Buffett held months ago, who knows if he still holds it now.
Right. The information is incredibly stale by the time you get it.
And their risk tolerance, the sheer scale they operate on, it's just not comparable to a retail investor. Plus, again, past performance isn't predictive. MAU made the key point. You need to understand why they made those investments, their philosophy, not just blindly copy the stock ticker.
Right. Copying what Buffett bought without understanding why is just mimicking motions. You don't have the conviction or the knowledge if things go south.
Exactly. You haven't done the real work, which kind of circles back to the big picture here.
Yeah. So what are the main takeaways from all this when we boil it down?
Well, copy trading definitely seems accessible, right? It lowers the barrier to entry for markets.
Sure. Seems easy.
But the risks are very real and maybe not always obvious. That increased risk-taking the academics found is a big one. And the real-world stories about scams, fees, technical glitches, traders blowing up, it suggests the reality can be pretty tough.
There seems to be a big gap between the slick marketing and the on-the-ground experience for many.
I think that's fair to say, which leads to the big question for you, the listener.
Right.
Is this really a shortcut to getting ahead? Or is it potentially a faster way to take on more risk than you intended?
And how much digging do you really need to do before you trust a stranger online with your money?
It really forces you to think hard about your own risk appetite, how much you actually know about investing, and what you're truly trying to achieve.
Definitely food for thought. So final thoughts, if people are still curious.
Well, maybe explore the platforms cautiously, use demo accounts perhaps, watch traders for a while without putting real money down.
Do your homework, basically.
Absolutely. And maybe, like MAU suggested, spend time learning the principles behind successful investing, whether it's from the legends or elsewhere. Build your own knowledge base.
That seems like solid advice regardless.
But the absolute number one thing echoed in that risk disclosure, and something we'd strongly agree with, talk to an independent financial advisor before you jump into copy trading. Seriously.
Get personalized advice for your situation,
Yeah.
your money, your future. It's too important for guesswork.
Couldn't agree more.